As we approach 2025, a significant year on the horizon, it's crucial for retirees and those nearing retirement to pay close attention to potential shifts in the financial landscape. The decisions made in Washington could have a direct and lasting impact on your hard-earned savings. New tax proposals from the Biden administration are currently under discussion, and these proposals are not just abstract policy debates. They represent real changes that could affect your bottom line. These changes could directly impact retirees' financial security, potentially altering the amount of money you have available for your daily needs and long-term goals. Retirement means relying on fixed income sources like a carefully constructed financial plan designed to provide stability and peace of mind. Social Security, a cornerstone of retirement income for many Americans, pensions, providing a steady stream of income based on years of service and savings, the culmination of years of diligent saving and investment. So any tax changes, even seemingly minor ones, can ripple through your entire budget, creating unexpected challenges and forcing difficult choices. Even a small tax increase on retirement income or investments, such as dividends or capital gains, could mean less money for essentials, forcing you to make tough decisions about where to cut back. Healthcare, a significant and often unpredictable expense in retirement or family support, the desire to help loved ones in need. That's why staying informed isn't optional. It's not just about keeping up with the news. It's about understanding how these changes will directly affect your personal financial situation. It's essential for protecting your nest egg, ensuring that your retirement savings last as long as you need them to. The proposed tax plan targets higher-income individuals and corporations, aiming to generate more revenue for government programs. But several provisions could affect a broader group of retirees than initially anticipated, impacting those who may not consider themselves high-income earners. Changes to capital gains, the profits you make from selling assets like stocks or real estate, Social Security taxation, the rules governing how much of your Social Security benefits are subject to taxes, and inheritance rules which determine how your assets are passed on to your heirs, are all on the table, meaning they are all potential areas of change that could impact your financial future. This makes it crucial to understand how your finances might be affected, so you can take proactive steps to mitigate any negative consequences. By the end of this guide, you'll know what the Biden tax plan could mean for you, gaining a clear understanding of the potential impact on your retirement income, investments, and overall financial well-being. You'll also learn how to start a conversation with your advisor, ensuring you're asking the right questions and getting the personalized guidance you need. This will empower you to safeguard your retirement and make informed decisions that protect your financial future. The Biden tax plan centers on raising taxes for high earners and corporations to fund government initiatives. Key proposals include increasing the top individual income tax rate, raising taxes on long-term capital gains and dividends for high earners, and changing the step-up in basis for inherited assets. There's also talk of lowering the income thresholds for taxing Social Security benefits and adjusting retirement account rules, potentially affecting more retirees than expected. Each of these changes could significantly alter your retirement strategy, so understanding them is vital. Social Security is the financial backbone for millions of retirees, so any change in its taxation deserves close attention. Currently, if your combined income exceeds certain thresholds, a portion of your benefits becomes taxable. The Biden administration may lower these thresholds or not adjust them for inflation, meaning more retirees could pay taxes on their benefits. Even a small increase in income, from a pension or IRA withdrawal, could push you into taxable territory, straining your budget. The goal is to strengthen Social Security's future, but the immediate impact could be higher taxes for today's retirees. Stay vigilant. Know how your income is calculated and how changes could affect your benefits. Retirement accounts like 401(k)s and IRAs are built on tax advantages, but proposed changes could alter their value. For retirees, the main concern is that higher marginal tax rates could mean larger tax bills on required withdrawals, especially for those with substantial savings. If you need to withdraw more to cover expenses, you could be pushed into a higher bracket, accelerating the depletion of your nest egg. There's also talk of limiting Roth conversions for high earners and changing rules for mega IRAs, signaling a shift in policy. The bottom line, tax rules for retirement accounts can change, so flexible strategic planning is more important than ever. Stay informed and review your withdrawal strategy regularly. Many retirees rely on investment portfolios for extra income, making capital gains tax changes especially important. The Biden plan proposes nearly doubling the top long-term capital gains rate for high earners, potentially matching ordinary income rates. While aimed at the wealthy, shifting thresholds could eventually affect more retirees. For example, selling appreciated assets in a single year could push you into a higher tax bracket, resulting in a much larger tax bill. Strategic planning, like spreading sales over several years or using tax loss harvesting, will become even more critical. These changes could fundamentally alter how retirees manage investment income. Estate planning is about leaving a legacy, ensuring that your hard-earned assets are transferred according to your wishes, and providing for your loved ones after you're gone. It's a process that involves careful consideration of your financial situation, your family dynamics, and your long-term goals. It's about more than just money. It's about values, relationships, and the future you want to create for those you care about. But proposed changes to the step-up in basis, a long-standing tax provision, could significantly alter the landscape of estate planning and inheritance. These potential changes are generating considerable discussion and concern among financial advisors and families alike. These changes could create new tax burdens for heirs, potentially diminishing the value of inheritances and complicating the transfer of wealth. Families need to be aware of these potential shifts and how they might impact their estate plans. The proposed plan would treat death as a taxable event, a departure from current practices that could have far-reaching consequences for many families. This shift in perspective could necessitate a reevaluation of existing estate plans. This would apply to unrealized capital gains above a certain exemption, meaning the increase in value of assets held during a person's lifetime. The specific exemption amount is still under discussion, but it will likely impact a significant number of estates. This would require estates to pay taxes before assets are passed on to beneficiaries, potentially creating a liquidity crunch for families inheriting property or other illiquid assets. The timing of these tax payments could be a significant challenge. This could force families to sell cherished assets that have been in the family for generations, to satisfy the tax obligations. This is a particularly concerning prospect for families with significant wealth tied up in real estate or other non-liquid investments. This could include a family home, a place filled with memories and sentimental value, potentially forcing difficult decisions during an already emotional time, or a family farm, a working piece of land that represents a livelihood and a legacy, potentially disrupting agricultural operations and rural communities, just to cover the tax bill, leaving less for the heirs and potentially undermining the original intent of the estate plan. For example, a property bought decades ago for a modest sum and now worth much more due to market appreciation. This could trigger a significant tax liability at death, even if the family has no intention of selling the property. These potential changes make estate planning more urgent and complex, requiring a proactive and strategic approach. Work closely with advisors to explore strategies to mitigate the potential impact of these changes. Consider strategies like gifting, which allows you to transfer assets during your lifetime. Explore the use of trusts, which can provide flexibility and control over asset distribution. Or leverage life insurance to provide liquidity for estate tax payments. All of these are ways to protect your legacy and ensure a smooth transfer of wealth. The path to passing on your assets in a tax-efficient manner may require more careful planning and proactive measures than ever before in light of these potential changes. Let's see how these potential changes in the financial landscape, specifically concerning Social Security thresholds and capital gains rates, could play out for real retirees, impacting their daily lives and long-term financial security. We want to move beyond abstract concepts and delve into concrete examples. Take the Millers, a retired couple, as our first example. They represent a common scenario for many Americans in their golden years. They're enjoying a comfortable retirement with $90,000 in annual income, derived from a combination of sources, including Social Security and income from appreciated stocks. Their financial well-being is closely tied to the performance of their investments and the stability of their retirement income streams. If Social Security thresholds drop, meaning more of their benefits become subject to taxation and capital gains rates rise, increasing the tax burden on their investment income, their net income could shrink, potentially forcing them to make difficult choices about their spending and lifestyle. They might have to cut back on leisure activities, travel, or even essential expenses. And selling assets such as stocks to cover unexpected expenses like home repairs or medical bills could trigger even higher taxes, further eroding their financial security. This creates a challenging situation where they're forced to deplete their savings and pay more in taxes. Or consider Sarah, a single retiree who relies heavily on her IRA for income. She faces large required IRA withdrawals each year, as mandated by IRS rules. These withdrawals are a significant source of her income, but they also come with tax implications. If tax rates rise, she'll keep less of her mandatory distributions, leaving her with less disposable income to cover her living expenses and other needs. This could significantly impact her quality of life and financial independence. Beyond their immediate financial needs, the Millers also hope to pass down a family cottage, a cherished heirloom, to their children and grandchildren. Under new rules regarding estate taxes and inheritance, their children could face a hefty tax bill upon inheriting the cottage, potentially diminishing the value of the inheritance. This could force them to make the difficult decision of selling the cottage to cover the tax obligations, effectively losing a valuable piece of their family history. These aren't just abstract numbers and hypothetical scenarios presented in financial reports. They're real impacts on retirees' lifestyles, their ability to maintain their standard of living, and the legacies they hope to leave for future generations. Planning ahead, working with a qualified financial advisor, and understanding the potential implications of these changes is the only way to avoid unpleasant surprises and protect your financial future. Understanding the numbers, staying informed about legislative changes, and proactively adjusting your financial strategy helps you make informed decisions that align with your goals and values, ensuring a secure and fulfilling retirement. Uncertainty is natural, but proactive planning is your best defense. Start by getting a clear picture of your income, investments, and current tax situation. Review your asset location. Placing high-growth assets in Roth accounts and income-generating ones in tax-deferred accounts can boost tax efficiency. Consider strategic Roth conversions if you expect higher future tax rates, especially during lower income years. Estate planning is more important than ever. Update wills, trusts, and consider gifting or life insurance to manage potential tax bills. Consult with your financial and estate advisors to tailor strategies to your situation. Preparing now means you'll be ready, no matter what changes come. Tax policy is complex and ever-changing, but knowledge is your best tool. The Biden tax plan could affect nearly every aspect of a retiree's finances, from Social Security to investments and inheritance. Don't panic. These are proposals, and the final laws may look different. The key is to build flexibility into your financial plan and stay prepared for a range of outcomes. Lean on your team of advisors. They're there to help you interpret changes and adjust your strategy. Your retirement security is built on years of smart decisions. Keep that momentum by staying informed and proactive. The principles of good planning, awareness, preparation, and action, never go out of style. Stay curious, keep asking questions, and you'll face the future with confidence.